Welcome everyone to this explainer. Today, we're diving into a genuinely baffling mystery that has completely upended the financial world during the recent tech earnings season. We're looking at the four pillars of global tech, and what their financial reports reveal is nothing short of a massive, unprecedented bet on the future. I'm absolutely thrilled to guide you through this because honestly, once you see what the numbers are actually saying, it completely changes how you view the entire industry.
Okay, so let's jump right into this bizarre reality. Imagine this scenario. Four of the most powerful tech giants on Earth generate nearly $450 billion in revenue in just 90 days. Record-breaking, mind-blowing numbers. And yet, how did the market react to this massive windfall? They sold. Stock prices actually fell. It seems completely counterintuitive, right? I mean, why on earth would investors dump stock in companies that are pulling in that kind of historic cash?
Well, the answer to that trillion-dollar mystery lies in one staggering figure. $496 billion. That is the planned capital expenditure, the literal physical cash these four companies alone are planning to spend in the year 2026. Not the whole stock market, just these four companies. They're spending this absolute mountain of cash to build the physical nervous system of our future economy.
To solve this paradox, we're going to look closely at the underlying financials. Our roadmap for this explainer is straightforward. We'll start with the big tech paradox itself, then move through four distinct case studies: Amazon's infrastructure, Google's unstoppable cloud, Microsoft owning the track, and Meta's record crash. Finally, we'll wrap up by looking at why the future requires a whole lot of patience.
All right, part one, the big tech paradox.
To really grasp why the market panicked, we've got to talk about Capex, or capital expenditure. Now, Capex isn't just some boring line item on an accountant's spreadsheet. It is a massive, tangible bet on tomorrow. We are talking about pouring billions upon billions of dollars into concrete, servers, massive data centers, and thousands of miles of underwater cables. It's the heavy, incredibly expensive, real-world lifting required to actually build out artificial intelligence. But here's the rub. When Wall Street analysts fire up their complex Excel models, they're laser-focused on free cash flow. They take all that amazing operating cash coming in the front door, and then they have to subtract those historically massive Capex numbers going right out the back door. The result? The free cash flow gets squeezed, sometimes to near zero. And in the financial world, you know what happens when the actual liquid money available today disappears? It triggers an immediate, visceral sell-off.
Which brings us to part two, Amazon and the infrastructure of the future.
To see this financial tug-of-war in extreme action, just look at Amazon's massive 95% drop in free cash flow. Last year, Amazon had a very comfortable $26 billion in free cash flow for the quarter. This year, just $1.2 billion. Poof. For an investor, it literally looks like every single dollar Amazon is bringing in is being aggressively shoved right back out the window to pay for concrete and servers. On paper, it looks absolutely terrifying.
But before you hit the panic button, consider the context here. $364 billion. That massive number represents the backlog of already signed contracts for Amazon Web Services. In just 90 days, that backlog jumped by $120 billion. Customers like the US Army, Apple, and OpenAI are so desperate for future computing power that they're booking capacity 5, sometimes 10 years in advance. Amazon isn't just building infrastructure on a prayer. They're building it because the demand is already locked in.
Moving on to part three, Google, the unstoppable cloud.
Remember when everyone feared AI was going to be the meteorite that wiped out the Google dinosaur? Yeah, well, they were wrong. Google is thriving. Their cloud division alone just hit $20 billion in revenue in a single quarter, growing at a blistering 63% year over year. Plus, their search monopoly, entirely intact and growing at its fastest rate since 2022. They've hit double-digit overall growth for the 11th consecutive quarter. So that cloud division, which was literally bleeding money just 2 years ago, is now a highly profitable machine.
But the most crucial detail comes straight from Google's CEO, Sundar Pichai. He explicitly stated that growth would have been even higher if they didn't have computational capacity constraints. Just think about that for a second. Google isn't limited by a lack of customer demand. No, they're physically incapable of building data centers fast enough to satisfy all the clients who are practically begging to give them money.
Okay, let's pivot to part four, Microsoft, and how they're owning the track.
Microsoft's Azure cloud grew by a massive 40%, and their commercial backlog reached an unbelievable $627 billion. Yet their stock still fell. Why? Well, think of it like a race. While everyone else is playing the role of the runner, fighting this brutal race to the bottom price war to build the smartest AI models, Microsoft is simply building the track. Through Azure, they are providing the foundational infrastructure. Honestly, it doesn't matter to them who ultimately wins the AI race because every single runner has to pay Microsoft a toll just to compete on their track.
And here is where Microsoft's ultimate, unassailable moat lies: integration. Every single hour an employee uses Microsoft's AI, Copilot, inside of Teams or Excel, that system is actively training on the enterprise's most sensitive internal workflows and documents. Once a company embeds its entire digital workflow that deeply into Microsoft's infrastructure, the cost of leaving becomes astronomically high. You aren't just swapping out a piece of software anymore. You'd literally be starting your whole business over from scratch.
Now for part 5, Meta and the record crash. This is, without a doubt, the most misunderstood story of our entire analysis. Negative $150 billion. That is the amount of market capitalization Meta lost in a single day. And here is the paradox hitting its absolute peak. They lost all this money the very day after publishing literally the best earnings results in the history of the company.
The paradox is wild because Meta's core business is firing on all cylinders. It's flawless. Ad prices, up 12%. Video watch time on Facebook and engagement on Instagram Reels are both up significantly. They've got 8 million advertisers successfully using their new generative AI tools. They somehow managed to increase the sheer volume of ads shown while simultaneously increasing the price of those ads, which is a magic trick that is incredibly hard to pull off. So why did the market punish them so ruthlessly? The punishment came down purely to their spending. Meta announced that their projected 2026 Capex is spiking to a staggering range of $125 to $145 billion. Wall Street looked at that massive wall of spending, realized it practically wiped out their free cash flow in their precious Excel models, and totally panicked. Why? Because Mark Zuckerberg couldn't give them a neat, exact timeline on when all this physical infrastructure would flip into quantifiable operating profits. And if there's one thing the market absolutely hates, it's uncertainty. Which leads us perfectly into part 6. The future requires patience. If we zoom out from the individual companies and look at the broader macroeconomic shift, the sheer scale of what's happening is staggering. When you add up the projected yearly Capex of just Amazon, Google, Microsoft, and Meta, you get roughly $700 billion. $700 billion of investment in a single year. To put that into perspective, that is more money than the entire GDP of several European nations. It's larger than the annual investments of entire massive industrial sectors combined.
But we've actually been here before. Think about the 1800s when we laid down the railroads, or the 1900s when we built out the electrical grid, or the 1990s with the massive fiber optic boom of the early internet. Every single time history takes one of these massive technological leaps, building the physical networks requires burning through unbelievable amounts of cash up front. It always creates uncertainty. It always creates risk. And there are always people who panic and sell just because they can't perfectly model the long-term value in a spreadsheet.
So I want to leave you with this final provocative thought. We are witnessing the exact moment where technological capitalism stops being just a high-margin software distribution business and physically transforms into a heavy infrastructure business. They are literally building the physical hardware of tomorrow right now. The market is always going to price in that short-term uncertainty, but if you want to participate in the construction of our digital future, you're going to need the rarest resource in all of finance. So the question is, do you have the patience for the future? Thank you so much for joining me on this explainer. Keep questioning, keep learning, and I'll catch you next time.